All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Mark Kimbrough.
Hey.
It's 10 a.m. Pacific time here, October 24th. Mark, I hope you got your Halloween costume all picked out, ready to hand out candy to all the kids in your neighborhood.
You know what? It's my second year having to do that, and I actually need to still get that candy. But I'll be wearing my Dodgers gear.
Oh, your Dodgers gear. Hopefully, we were just talking about the LAFC has their first playoff game on Wednesday, the 29th. And someone threw out there that it also could be game 5 of the World Series. And I said, if there is a game 5, so either way, the series could be over by the time Halloween rolls around for you.
If so, hopefully the right way. So,
all right, let's get into where are we for the week here. Good week in the stock market. S&P up about 2%. Time of recording. Tech, your big winner, up 3 and change. Followed closely by energy up 2 3/4, and industrials up 2 1/4. One sector negative on the week. That's consumer staple, down about 50 basis points. Still, we're looking at month to date. We're up 1 3/4%, and still rounding a nice almost 17% on the S&P 500 on a year-to-date basis. Really looking at the sectors, tech up 27%, pretty amazing. Communication services up 20.7%, and utilities, surprisingly, the second best performing sector on a year-to-date basis, up 23.5%. Shifting back to the week, though, we kind of have Russell 1000 up 2%, Russell 2000 up 2.6%. So your small caps doing a little bit of outperformance there. Growth continues to outperform value with up 2.2% and value up 1.7%. So overall, pretty good week, pretty good breadth of returns. S&P equal weight up almost 2% on the week. Given there's no real data, pretty quiet week. Just keeps chugging along.
Yeah, I mean, if we can hold these levels right now, at least for the S&P, we're sitting at new all-time highs today. Had a nice little week and a half drought or so, but trying to push forward again.
A whole week and a half without all-time highs. All right, let's shift over to the bond market, and the 10-year's at time of recording 3.99. 2-year is at 3.48, so 2-year still below that 3.5 level. We're looking at 1, 2, 3. Yesterday we actually closed at 4.00 on the 10-year, so I would say we had 3 days in a row of below 4%. And if it's all just kind of hovering around that 4% though for the past 2 weeks, 4.03. So really not much going on in terms of your volatility, as you would expect, given the lack of macro data out there in for the bond market to really dive into. Because of that, because of those kind of very small movements, we kind of earned the carry over the week. Ag up about 16 basis points. U.S. Treasuries, the laggard, only up 12. Agency mortgages up 16, and investment grade corporates being your big winner there, up about 34 basis points. Given that, as you would expect, your non-traditional fixed income sectors did better. High yield up 38, bank loans up 34, and EM, the big winner, up 80 basis points on the week. Still looking at a 740 return on the ag year to date. I think that if you annualize that out, we're still above 9%. So still above the long-term stock market return we're going to get from fixed income for this year. If we kind of extrapolate out.
It's a nice year for bonds, nice year for assets in general.
That's right. And let's round it out with commodities. Commodities up almost 2% on the week. Commodities actually up 12.5% on a year-to-date basis. So, Mark, as you said, green across the board for your big 3 kind of asset classes on a year-to-date basis. Energy, the big winner, up 6.6% on the week. That's all on the back of WTI crude oil is up 7.5% on the week. That's really because of the U.S. administration announced sanctions on Russia's 2 largest oil producers and caused the oil to rally yesterday about 5%. So that was most of that move there in oil was yesterday. It kind of we're still up, we're kind of flat today. Really, there's the idea that even though we got the short-term bump, OPEC may come in and with higher production and kind of make up for the difference that the lost Russian oil could be. It's about 3 million barrels per day. And so we'll have to kind of see how that plays out. But OPEC could come in. There's talk that overall, basically, it's going to be an unchanged market, kind of around this level. So nothing really too exciting. I guess that's the big exciting news for the week there. Oh no, I do have another exciting piece. Gold is actually down
There
on
we
the
go.
week, minus 1.5%. This is the first time since mid-August that, obviously we could get a 1.5% rally from right here, and gold could end up positive. But as of time of recording, we're a negative. First time since mid-August that it looks like we could turn in a negative week. Gold is up 23.5% since that mid-August time period. So, that's not a very long time for up 23.5%. We'll have to kind of see how things shake out here, but I guess that is the other big thing is a negative week on gold.
That was our bit of vol for this week. The energy and the gold. Those were our two. We don't have our big economic data points, but we have those market moving events there.
That's right. Well, I mean, let's get into the data points. We finally got a data point today. Didn't really move markets too much, but Mark, why don't you hit us up when what was going on in macro land?
Yeah, you know what? It was going to be a light week even without the government shutdown. But I'm going to touch on one data point. We had Thursday initial jobless claims. Did not receive it for the week ending October 18th. But if you look at state level data, it suggests a print of around 227K. Last time we got an actual initial claims report, the 4-week moving average is around 238K. So nothing really to see here. Still kind of steady issue drifts. But as you said, like today, we got our first real economic data print in a while, meaningful one. We got CPI today. It was released because they needed to calculate the cost of living adjustments for Social Security payments next year. So it was determined this needed to be done, and here are the results for the month of September. The report in general for both month-over-month and year-over-year figures for the core and headline all came in under estimates. Let's just dive into some of these details here. We had the headline came in at 0.31% month-over-month, 3.01% year-over-year. It's the highest print we've seen, on a rounded basis, materially right in line with January of this year. Part of the reason for the elevated monthly print this month was energy. It was up 1.51%, contributing just under a third of the total print for the month. That's up 2.85% year over year. As you mentioned, we had a little bit of a spike this month so far this week in energy. You couldn't have falling energy prices go on forever to act as a little support for CPI, the disinflation with CPI. Food inflation remains elevated. It was up 0.25% this month, just 3.11% on the year. Again, remains elevated. But going to the core CPI, this came through for the month at 0.23%. It was up 3.02% year over year. It's a decent level, but it's it's better to look at the actual components underneath that. I want to get into the core services and core goods. We'll start with core goods. It was only up 22 bips this month, 0.22%, 1.54% on the year. That left the year-over-year number unchanged from the prior month. I will say it's nice to see core goods take a bit of a breather from their ascent from negative territory. Maybe this is, we're sitting somewhere below 2% on the core goods side. I'm just going to take comfort in that we're no longer accelerating to the upside.
You say that, but I say you need core goods deflation if we're going to get a 2% inflation.
So, I agree with that. That's more the normal state of things. This is the derivative of that. We're just it's no longer getting more painful, but there's still a lot of improvement that's needed to get back to normal times, as you're saying. It also gives us with core services that came through at 0.24% this month, positive, up 3.4% year over year. And I'm going to say that year over year number, while still extremely elevated, is the lowest year-over-year number we've seen since November of 2021, when this whole rise began. So again, the disinflationary trend still exists in core services. If you look under the hood in core services, we have the shelter component makes up a little over a third of the basket of CPI. That print came through, the shelter component came through at 0.21% this month. And that is the second lowest print we've seen going back to August of 2021. So it's good to see that disinflation is still there. It's possible this is a bit of a payback. We had a bit of a spike up last month to 44 bips. So maybe this is just, level it out a bit, but it's nice to see that the core services side is coming back under control. And so, all in all, CPI, this was a good month for CPI. I'll say nothing surprising to scare us. This market should be comforted by this. And lastly, today we got the S&P Global U.S. U.S. PMI data for October. This is prelim. I can summarize this all pretty quick, actually. It's everything remained in expansion territory. Everything exceeded estimates and the prior. This left the composite measure on a 33-month streak of expansion. And it was noted by the chief economist over at the S&P Global that this print was indicative of a 2.5% expansion in the economy on an annualized rate for this month. So call it strong start to the month or to the fourth quarter. Look, if I'm looking at manufacturing data, the data there there's a couple things to mention on it. It's in expansionary territory at 52.2, but there's things to mention with regard to tariffs in the front running and now where we stand after. The report notes that while a lot of manufacturers went and bought goods in advance of tariffs and stockpiled inputs, they've been working through those inputs, and now we're at a point where they're not selling through all those inputs and are now seeing stockpiles start to build up at an unprecedented rate. So that could result in maybe some price wars, so some desires to try and get pricing down to compete to actually get rid of that inventory. This also could decrease some of the inflationary pressure on the need to buy inputs. If they're sitting on a stockpile of completed goods that they need to sell, they don't need to load up on those inputs like they did pre-tariffs. So just a little bit of a concern there on the manufacturing side that was noted in the report. Again, they're still currently performing at good levels, but it's concerns on the horizon. On the services side, things are still looking good. Nothing really to dive into there. Employment's still expanding. Demand is still there. So nothing concerning this report to mention. And you know what? That covers the prints that came out, but there's one more random thing I wanted to talk about. And that is, I shouldn't say random, one more important thing to talk about. And that's, look, two of the most important data sets we look at for all the stuff the Fed looks at deal with employment and deal with inflation, the two Fed mandates. And I want to talk about how October prints could be impacted if the data ends up being delayed, if this government shutdown persists. I think as of this morning, we had some of the betting markets suggesting that we're now, 30 something days into the shutdown, and the betting markets are suggesting it's going to extend for about 44 days. So talking about the establishment report, the household report, and CPI data. The establishment survey has noted that in the event there are delays collecting this data when the government reopens, that there actually is minimal impact expected to this report for the month of October. Historically, not been much of a bias up or down for the October data when it comes to late data that's received, which suggests that the late data you receive is still good quality data. It's still indicative of being able to come up with a quality NFP print. Now, if we look at the household survey, this is the U3 unemployment rate. I got a quote here from the Census Bureau. They had research back in the 1970s, so reaching back quite a bit here, but it says, quote, biases in labor force data due to recall are quite high and at an unacceptable level of quality. In particular, unemployment in the first month was understated significantly in the second month's interview, end quote. So effectively, they're saying when you ask people to recall what their employment situation was, that data gets worse and worse as time passes. Their memories fade, and that data is noted to be of lower quality. So it's just suggests for this report, when it does come out, the longer time passes, the lower confidence we should have in the meaningfulness of that report. That can get cleaned up in the report that follows, but that would be how it speaks for the October number. And lastly, CPI. This one is the most at risk to poor quality data. A majority of CPI data is collected by hand throughout the month. We're currently on the 24th day of the month, so we've missed much of that time to collect all the data. And actually, throughout this year, there's been news stories talking about how data collection efforts have already been experiencing some challenges. So if we're adding further impediments, further delays in collecting that data, it again could chip away at the quality of the October print. Maybe we get a number. It's just we need to discount it by a little bit. Just putting that out into the universe because the Fed has spoken about this before, or other economic the releases of this data have spoken to this. So I wanted to highlight that, and that wraps up our economic data for the week.
So basically what you're saying, Mark, is that we're flying blind until January.
And paraphrase perfectly.
All right. And with that, we can talk about the Fed. And the Fed is, our market is pricing in 97% chance of a Fed cut next week on Wednesday. Another 104% chance, so 100 plus chance of a cut on December 10th. And that doesn't really feel, since we're going to be flying blind, doesn't really feel that much is going to be able to nudge the Fed off of that course. Mark, you do have noted here that, it's a 50% chance of a cut in January, 50% chance of a cut in March. That kind of gets us to that 335, 325 type level in terms of Fed funds. And a lot of people are saying that's kind of your neutral rate. So we could be getting down to that neutral rate in the first half of next year. And it'll be interesting to see how things shake out there. With that, it's kind of interesting also that, obviously next week we would have got PCE, but we just got CPI. So I think nothing really to do there. We will get housing price data. So that will be the one data point that we do get, along with the Fed decision on Wednesday. It'll be interesting to see also, like Jay Powell had hinted about the slowing down or the stopping of the quantitative tightening. I think that'll probably be a lot of questions from the press conference will be about that. So we'll have to see what Jay says about that. There are some Wall Street firms that are saying he's actually going to stop QT on Wednesday. I think that's probably a little bit aggressive. Probably hint at it, come up with the plan or announce the plan in December. Probably, could be end of December when they start. But to think that they're going to stop it, there's really nothing out there that's like showing that we're super. We need to stop it today. Doesn't seem like we're in that kind of market environment. So
yeah, we're having all this economic data not existing. We don't need a surprise, thrown at us by the Fed either.
I think maybe Jay's just like, we got to get some vol in the market. Let's do that.
Yeah,
all right.
That seems a bit counter.
But with that, I think that wraps it up for this week.
Yes, thanks to our listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget our website is doubleline.com, YouTube channel, youtube.com/doubleline capital. Given it is the Fed on Wednesday, we will have Jeffrey Gundlach on CNBC right after the Jay Powell press conference. And Ken Shinoda will be on Bloomberg TV at around 12:50, so right before the close there on the same day. So Fed Day, a good day to kind of keep an eye on what we're talking about out there. I'd like to thank everyone for tuning in and hope everyone has a great weekend.
Yes, thanks everyone out there. Stay safe.